We're going to go over risk and volatility so that you can better understand your KiwiSaver. To do that, we'll look at a few examples of different funds, their typical behaviors we expect from them, and the pros and cons. We'll first look at the conservative fund, the gray fund here. This fund is amazing at the short term. It's impacted much less from volatility. So if a big world event like COVID or 9/11 happens, you'll see less of a dip in your KiwiSaver balance. However, the negative is that a conservative fund won't do as well helping people achieve their goals of a first home or retirement in the long term. You won't get those returns that you're looking for. In fact, it can even struggle with keeping up with inflation and fees. The green fund, the aggressive fund, it's the exact opposite. It can really help people achieve their goals in the long term of a first home and retirement, but you will see a much bigger dip in your KiwiSaver balance if there is volatility from something like a big world event. And of course, a bounce fund is somewhere in the middle. Now, a conservative fund is great for people who have the short term on their mind. Perhaps they're going to withdraw very soon for their first home or for retirement. So they want to protect those funds by keeping them in a conservative place. If you are someone who has a long term on your mind, but you're in a conservative fund, that's a strong indicator that you might want to get some advice from an advisor and look at different fund options. The same goes for someone who's in an aggressive fund, but they don't have a lot of time on their side. In fact, this can be a rather large risk for people because if you're looking to withdraw your money in a year's time for a first home and a big world event happens, it may impact your balance, meaning that you have less money to take out, or you'll have to wait until your balance comes back up, and that can mean waiting on buying your home. If you are in a more aggressive fund and you're focused on the long term, you of course will see your KiwiSaver balance dip from time to time. When these dips do happen, we don't want to switch our funds from a more aggressive fund to a conservative fund because we'll be locking in the loss. Instead, we want to ride it out and wait for those funds to shoot back up. One really good thing to know when you do see a dip in your KiwiSaver balance is that dips are a healthy part of a long-term investment strategy. In fact, they can even be beneficial, and it can mean more money in your pocket when you do retire or take money out for your first home. Now, to understand this a bit better, we'll quickly explain what a KiwiSaver balance consists of. So it's made up of the unit price, but also the number of units that you own. Okay? When you see a dip in your KiwiSaver balance, what you're seeing is the unit prices go down. However, because the unit prices are cheaper or lower, when you contribute your 3% or more from your pay, you're buying a larger number of units. When they go up in value, you've just gotten a deal on buying units of an investment. And eventually, when you go to retire or withdraw for your first home, you will have made more money from buying more units of investment in this dip than you did up here when times were good, when your KiwiSaver balance was higher. So that's a quick explanation of how you buy low and sell high naturally, and how seeing a dip isn't always a bad thing. In fact, if you have your strategy in place, it can actually benefit you. Like always, thanks for watching.